5 giant companies are about to report earnings, and one of them could be the biggest winner of the week. We're talking about ABBV, Lind, ExxonMobil, Chevron, and Eaton. Some of these companies offer stable dividends, some provide exposure to artificial intelligence, and others could benefit from rising energy prices. But if you could buy only one stock before earnings, which one should you choose? Let's find out. Earnings season is one of the most exciting times for investors because stock prices can move dramatically within just a few hours. A company can beat expectations and surge higher, or it can disappoint investors and fall sharply. That's why understanding the numbers is extremely important. Today, we'll analyze 5 major companies and rank them from worst to best. Let's start with ABBV. Wall Street expects earnings per share of $3.61 and revenue of approximately $17 billion. AbbVie is one of the world's largest pharmaceutical companies, generating billions of dollars from its extensive portfolio of medicines. The company also offers an attractive dividend, making it popular among long-term investors. However, competition and slowing Humira sales remain major concerns. If management delivers strong guidance, investors could see substantial upside. Next up is Lind. Analysts expect earnings of $4.49 per share and revenue of around $9 billion. Lind isn't a company that receives a lot of media attention, but it plays a crucial role in the global economy. The company supplies industrial gases to semiconductor manufacturers, healthcare companies, and data centers. As artificial intelligence continues to expand, demand for Lind's products could increase significantly. This makes Lind one of the strongest long-term investments on today's list. Now let's talk about ExxonMobil. Wall Street is expecting earnings of approximately $3.63 per share and revenue close to $98 billion. Exxon remains one of the largest energy companies in the world. The stock's performance depends heavily on oil prices, which means investors should expect greater volatility. If energy prices continue to climb, Exxon could deliver better than expected results. But if oil prices weaken, the stock could come under pressure. Another major energy giant reporting earnings is Chevron. Analysts expect earnings per share of approximately $5.57 and revenue of nearly $60 billion. Chevron has built a reputation for maintaining strong cash flow and rewarding shareholders through dividends. However, just like Exxon, the company remains vulnerable to fluctuations in oil prices. That uncertainty creates both opportunity and risk. Finally, we arrive at Eaton. Wall Street expects earnings per share of $3.08 and revenue of approximately $8.2 billion. At first glance, Eaton might not seem as exciting as some of the other companies on this list, but the story becomes much more interesting when you look closely. Eaton is deeply involved in power management, electrical infrastructure, artificial intelligence, and data center expansion. As demand for electricity grows around the world, Eaton could become one of the biggest beneficiaries of this trend. That's exactly why many investors are paying close attention to this company. Now it's time for the rankings. Number 5, Chevron. Number 4, AbbVie. Number 3, ExxonMobil. Number 2, Lind. And finally, the number 1 pick is Eaton. Why? Because Eaton combines strong financial performance, exposure to the artificial intelligence revolution, and long-term growth opportunities. Remember, earnings season can be unpredictable. Even great companies sometimes deliver disappointing results. That's why investors should always manage their risk and invest carefully. So, which stock are you buying before earnings? Let me know in the comments below. And don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss another stock analysis. Thanks for watching, and I'll see you in the next video.